1 in 3 Americans has zero in an emergency fund, while the median amount for those who do is only $500. While many investors obsess over finding the next hot stock, they are pouring capital into a bucket full of holes. The order you invest your money is just as mathematically critical as the amount you save. To execute this sequence, you need to gather 3 data points: the interest rates on any current debts, your employer's specific retirement matching policy, and the details of your health insurance plan. Locking in this exact sequence today eliminates financial paralysis. It provides a roadmap designed to prioritize every dollar for its highest mathematical return. Step 1. Build a foundation. A $1,000 liquid safety net covers minor emergencies. This operational buffer ensures you never sell long-term assets at a loss when a car repair hits. Step 2 is the only exception to paying debt first: the employer match. A typical match provides 50 cents on every dollar you contribute up to a certain percentage of your salary. This represents a 50% immediate return on your capital before your investments earn a single penny. Your employer is legally obligated to provide this match if you participate. Leaving it on the table is the most expensive baseline error an investor can make. Step 3 utilizes the debt avalanche method to systematically destroy consumer debt before you begin aggressive investing. Audit your debts and identify anything with an interest rate above 8%. Rates below this threshold can be paid over time, but anything above 8% is a priority for immediate elimination. This visualization shows why. The average credit card interest rate currently exceeds 22%. Warren Buffett's long-term average annual return is roughly 20%. If you carry credit card debt while investing, you are statistically losing that race every month. Pay the minimums on all other balances and route every extra dollar you have toward the debt with the highest interest rate first. Every dollar directed at a high-interest balance earns a guaranteed tax-free 22% return. This makes debt elimination the most efficient allocation of capital available to you. Step 4 is maximizing an individual retirement account, or IRA. This account gives you complete control over your assets, independent of your employer's plan. This chart shows the impact of fees over 30 years. Company 401ks often have 1% annual fees. An IRA allows index funds with 0.03% fees. That tiny difference saves tens of thousands in lost compounding. If you are early in your career, a Roth IRA allows you to pay taxes at today's lower rates. If you are in your peak earning years, a traditional IRA provides an immediate tax deduction when it is most valuable. Step 5 is the Health Savings Account, or HSA. For those enrolled in a high-deductible health plan, this account offers tax advantages that are unique within the U.S. tax code. The HSA provides a triple tax advantage: a tax deduction on the way in, tax-free growth while invested, and tax-free withdrawals for medical expenses. If you can afford to pay medical bills out of pocket, you can save your receipts and reimburse yourself decades later. This allows the HSA capital to compound entirely untouched for the long term. With average couples expected to spend over $300,000 on healthcare in retirement, a fully funded HSA acts as a secondary retirement account, specifically designed to neutralize that risk. Step 6 is returning to your 401k. Now that your foundational accounts are established, increase your contributions toward the federal maximum limit. Maximizing an IRA, a funded HSA, and a 401k can shield $35,000 a year from current taxation. This creates a massive wealth-building engine that very few investors ever fully utilize. Step 7 is the taxable brokerage account. This is the final destination for any capital left over after all tax-advantaged spaces are filled. A taxable account offers total flexibility for early retirement or large purchases before you can access retirement accounts. However, be aware that dividend and capital gains taxes will create a continuous drag on your long-term growth. Reaching this final stage means you have maximized every possible mathematical advantage, placing you in the elite top 5% of savers in the country. This is the sequence: the emergency fund, the employer match, high-interest debt, the IRA, the HSA, the 401k max, and finally, taxable accounts. Audit your bank account today to see where you sit in this order. Identify your current step and automate your next transfer to begin filling that specific bucket. Wealth is built through the disciplined execution of these fundamentals. Success comes from adhering to the right order and ignoring the distractions of market timing or speculative gambling. The math favors those who follow this specific sequence with consistency. By prioritizing guaranteed returns and tax advantages over speculation, you systematically build a portfolio that outcompetes the vast majority of investors.